Well, good afternoon, everyone. This is Tony Whitbeck. I'm the CEO of Key Management Group. And with me today is Todd Doherty, who is our Director of Acquisition and Legacy Planning. And welcome to today's presentation entitled Common Mistakes Made When Selling a Practice. Before we jump into today's content, I want to take just a minute to explain who we are. So Key Management Group really is a comprehensive consulting firm that provides services to the financial services industry. We have nearly 30 employees at our company, and we have coaches that work across the country with practices perhaps like yours. We offer a number of different services. We have 4 different assessment tools. We have an in-depth practice assessment, evaluation, and HR assessment. And then we have a host of leadership services. And today, we're really here to focus on our acquisition services and to talk more about the mistakes that people can make by trying to sell the practice on their own. So what I'd like to do next, I'd like to turn it over to Todd, and Todd's going to take us through the rest of today's content. So Todd?
And sorry about that, I was muted there. Thank you, Tony, and thanks to all of you for joining us today. We're entering a very interesting time in our industry where we're going to see a record number of practice transitions over the next 7 to 10 years. As you can see by the chart on the screen, the majority of advisors are currently over the age of 50. 21% of advisors in the workforce are over the age of 60, and those advisors control the majority of the assets under management today, estimated to be $2.3 trillion. The significance of this age wave, as it's called, or the result of the baby boomer generation retiring, is a shift from what has been a very strong seller's market gradually into what will become likely a buyer's market. And we really started to see that shift at the beginning of 2016 with the initial results of it being buyers being a little bit more selective than they have been, especially in respect to smaller practices for sale, or maybe those that aren't as good of quality. They generally didn't have as much interest as they used to see, and a little bit lower interest in general. But that's not to say there's not plenty of interest, and there will continue to be so. It's just a more challenging market for sellers. And as we move into the next 5 to 7 years, that trend will only increase, as well as some other downward pressures on valuations that we discussed in our valuation webinar. So let's take a look at some of the considerations of selling a practice. And the interesting thing that we've noted over the years is that advisors often spend a lot of time and energy thinking about when to sell, but they rarely think about how to sell the practice. And I think that has a lot to do with not understanding the options of how you sell a practice. So it's helpful to consider, different types of sales and the pros and cons of those. And we're going to spend a fair amount of time today talking about those 2 different types of sales. The result of advisors not focusing on how to sell the practice is really a diminished value of what is probably the most important transaction of your lifetime. For most advisors, the value of the practice is their largest personal asset, if not one of the larger personal assets in their portfolio. And most selling advisors have a very sincere concern over the welfare of their clients and would normally cite that as their primary consideration when it comes to their succession. So the diminishing value that results from the inexperience of advisors or just simply not understanding options is both quantitative and qualitative. It generally results in a lower value deal, lower price, perhaps not as good of terms of the deal. And oftentimes it results in the advisor not selecting the best successor for their clients or, in fact, themselves. So we're going to try to give you some insight into the different types of sales that you can navigate, and what are the other considerations around making sure that the process is done properly. So there are really two different types of sales. There are both a closed sale, and that's where an advisor and a buyer and a seller identify each other and are really determined to work together to sell and transition the practice. The other type of sale is an open sale, and that's where generally the advisor would work with an M&A firm or M&A experts or consultants who would then publish the practice for sale to a wider audience of potential buyers, and then through a process of vetting, narrow down that group to a more and more qualified advisor or team until the buyer can be selected from that larger pool. Most of the sales that we see are closed sales, and both are very appropriate for the right situation. There's certainly nothing wrong with a closed sale or an open sale. It's really because more closed sales happen as a result of advisors not knowing their options that oftentimes the closed sale is not the best outcome. It's not that the sale itself would be a bad outcome. It's simply the advisor didn't understand that there were other options, and they might have simply entered into a closed sale because that was the only process that they were aware of. So there are certainly pros and cons to each. Let's talk about the closed sale first. The main pro in a closed sale would be a situation where you're selling to an advisor who you have a long-term relationship with, and through that relationship, you've perhaps even had some joint servicing of clients, or at least you understand that advisor or team is an excellent fit for your clients, and they have a similar client service process, similar values, similar client relationships. So that would be the best scenario for a closed sale, and it's often the reason why people engage in one, and that would be the good reason to do so, certainly. Oftentimes that would facilitate some type of introduction to the clients over a longer period of time, and that could certainly create a smoother transition for the clients, and hopefully a lower attrition rate of clients when they actually formally change hands. One of the cons of the closed sale, and this is something that we see quite often, is that in that process, advisors will tend to use a DIY or do-it-yourself methodology because they feel like they're dealing with someone they know. Oftentimes they're using templates that the broker dealers provide for the agreements and so forth. They think that they can just go ahead and complete all of the process themselves without having the help and assistance of professionals, and that's where we see some really significant issues come about, and certainly it reduces the overall outcome of the process and sale. Some of the things that come out of that would be lower price and terms, complicated terms, lack of best practices around the transition planning of the clients, and really that list goes on and on. We've seen quite a few outcomes that weren't favorable as the result of a do-it-yourself process. In an open sale, the pros are really getting in front of a larger group of prospective buyers, being able to vet that group to the smaller group but greater qualifications, and eventually choosing what will really be the best of the best. And that can be quite a benefit, not only in the quality of the buyer and their team, but also in the deal that you get. And generally speaking, an open sale will bring about the best monetization of the equity because it is a competitive situation, the most favorable terms for the same reason, and I think we would argue oftentimes the best fit as well. The cons of an open sale are generally the selling advisor is getting out of their comfort zone here. It requires, a longer process in most cases because you're doing more vetting. It requires the advisor to put themselves out there a bit to get to know a larger group of potential candidates. But because it is such an important transaction, we generally feel that that time and effort is well worth the return that you get from it. One of the things that we've certainly noticed over time is that the selling of a practice is a very emotional process for the seller. And this can make it difficult for the seller to make good business decisions during that time frame, or to be able to separate the emotion from those business decisions. It also means that it's a bit easier for the buyer to get their way in a deal, and especially because buyers tend to have more experience in these transactions than sellers do. Most sellers will only sell one business in their lifetime. Again, it's probably the most important transaction that they'll ever go through. And many times, hiring a consultant late in the process, they've really already poisoned the well, if you will, due to their inexperience and not knowing what the best practices are and industry standards are in respect to deal making. Sellers concede to the buyer's terms quite often, and they're really reluctant to negotiate those terms because they don't have the experience negotiating, which is really an art in itself. And they don't know, again, what the standards are, what the options are, and et cetera. A good example of this is the terms that are related to the attrition of clients. I've literally seen those terms written 100 different ways or more, and generally speaking, when the terms are provided by the buyer, they're overly complicated and really put the seller at some undue risk. And so that's a common term that we see a lot of mistakes made, and a lot of sellers putting themselves in a position to risk a lot of value of the business if they accept the buyer's terms. Certainly there's more examples of that, and we'll talk a little bit more about that as we go through the presentation. Some other items that we see in respect to the do-it-yourself approach is either no valuation or a dated valuation used in the sale. I'd say that's definitely more common in a closed sale, when oftentimes the buyer and the seller had entered into a buy-sell agreement many years in the past. They probably used what is now a dated methodology for value. Usually it's a very simple multiples of revenue. Often, what we see is 2 times recurring, 1 times transactional, and that's certainly a dated value methodology. Sometimes there's no valuation at all. They simply accept an offer because they feel like it's close enough. But close enough can mean thousands of dollars, or in some case, more than hundreds of thousands of dollars for an average size practice. Not using an attorney, another common mistake that we see. I think that results largely from the use of agreement templates, but you'll note in those templates provided by the broker dealers that it says in several places, do not use this without the help of a professional, legal counsel. And there's a very important reason for that. What those templates don't include is the most important part, and that's the specific terms. They specifically don't include the terms because the broker dealers don't want to be responsible for defining terms between 2 business owners. So using an attorney is a critical step that's often either overlooked or neglected. Improper allocation of the taxes in respect to the sale price. I can't tell you how many people we work with who didn't even know about tax allocation and didn't know that the sale price is allocated to different things like goodwill, which is capital gains, or consulting, which is ordinary income for the seller. And so having the help of a tax professional, understanding the industry standards in respect to those areas is extremely important. There are oftentimes missing terms in agreements, and especially in the older style buy-sell agreements that we see, they don't talk about things like consulting. They don't talk about often things like non-compete, sometimes even tax allocations, some pretty important items. So that's the other risk when you're not using an M&A professional. And then the other thing that we've seen over and over again is extremely complicated terms, which is interesting because if those parties had a better understanding of the industry standards for terms or best practices around terms, they would also realize that they're fairly simple. They don't need to be complicated. And I would certainly argue that the less complicated they are, the better, because it leads to a better understanding between two parties, and certainly into more enforceable terms should something unforeseen come up and those terms need to be enforced. I think the attrition example is a good one of terms that we see that are very complicated. There are also very complicated terms in respect to the consulting period, other items like that. One of the things that most professional negotiators, or those who are experienced, understand that most people don't, is that not all of the value in a deal is monetary. In fact, some of the items which you would refer to as items of unequal value have nothing to do with the price or terms, but they're very important to one or the other parties. And those are often the items that can make or break a deal. Having a third party involved in doing the negotiating can be a benefit beyond the monetary value as well. One of the things, and this is a feedback that we very frequently get from our own clients, is one of the items that they appreciated the most was being able to maintain the relationship between the seller and the buyer by not having to do the negotiating. And so you have that intermediary, if you will, who's, having the difficult conversations while the two parties can maintain a very good relationship through the process and then continue that on during the transition of the practice. As I mentioned, it's a very emotional process for sellers, a very stressful process for buyers. And again, having a third party can really help you separate the emotion from good business decision. The other thing that we see quite often, and more so with time, is that exit strategies are becoming increasingly complex. We're seeing quite a few situations where an advisor is looking to monetize the equity but not retire, which is certainly a good idea in a lot of cases where the equity might decrease over time, but they're not really ready to stop being an advisor. And so in those situations, you're not just navigating the sale of the practice and the terms, but also what is your ongoing consulting with the buyer going to look like? And those arrangements can have their own complexities, certainly. Having a consultant who understands how those things work, what you're allowed to do and what you're not allowed to do, and what they've seen in terms of best practices in the past can be a huge help there. And those areas can be quite complicated. So there's a lot of value of using professionals that goes beyond the price and terms that can make a big difference to the qualitative experience of the process itself. Many advisors also don't know about the more modern way that deals are financed today. Used to be, and probably 5 years ago, 6 years ago, that most deals or almost all deals were seller finance. And so the seller would act as the bank. They would get a relatively small down payment of around 20%, and then they would carry a note for an average of about 5 years. Today, the situation is quite different, and I would argue greatly improved, because most deals are bank financed. What that means really is an improvement for both parties. For the seller, they're monetizing the majority of the equity at closing, and so the bank, the portion that they finance, which is usually the majority of the sale price, will be paid to the seller at closing. For the buyer side, they don't have to come up with a cash down payment because the bank's payment acts as the down payment. And they also get a much longer note from the bank of 10 years versus a typical seller finance note of 5 years, which greatly improves the buyer's cash flow. The good thing is that we have banks that specialize in our industry as a vertical, if you will. And we work specifically with two of the probably the largest lenders in the industry, that being Live Oak Bank and PPC Loans. So understanding that there are two very appropriate options for selling a practice, we have service options for either one of those types of sales, for a closed sale or for an open sale through our Advisor Legacy platform. So I'm just going to take a minute and talk about these two options. So the closed sale, we have a deal package that basically puts all of the necessary elements of putting together a deal, negotiating the price and terms, having an attorney complete the formal agreements, and then working with a coach to plan the actual transition. And we put all of those elements into one package with a flat fee of $79.95. So that's very appropriate, where, again, two parties have engaged each other. They want to buy and sell with each other, but they also want to do it correctly and make sure every element is involved in the process and professionally completed, from the valuation all the way to the planning of the transition of the clients. The other option is our open sale, and that's done on our Advisor Legacy platform. And I'm going to talk a little bit more about that. But what that process can include as well is a practice valuation, access to literally hundreds of qualified buyers who are registered on our Advisor Legacy platform, the vetting of candidates, and again, starting with a large group and vetting it down to the best of the best candidates, and also a better than average deal in respect to the price and terms. And then finally, the coaching through the transition and closing of the sale. The fee for this service is based on a percentage of the sale price that has a range of 2 to 6%. And that range is based on the size of the practice. So a larger practice has a lower percentage fee. I believe our average fee is around 4.5%. So let me just talk briefly about the Advisor Legacy process, because it's the one that fewer people are familiar with, and in general, open sales are less familiar. So the first thing that we do in the process is we meet with you to create a profile of the practice. So we'll talk about, your goals, collect information from you. We'll ask you to write up some information that will go into the profile. And then that will be published on our Advisor Legacy website. If you are an advisor in one of our partner firms, which are Ameriprise, Cetera, Northwestern Mutual, or Raymond James, then only other advisors in those firms will see that listing for sale. The next thing that we're going to do is we're going to work with you to create a terms sheet. So we're going to define the terms that you're looking for in the deal. And we're going to collect any names also of advisors who you might have spoken with before who would be interested in the sale, and make sure that they're notified as well in case they're not already registered as a buyer on our platform. We'll also find other local buyers in the area by way of working with the local field leadership or the broker dealer, et cetera, and make sure we're really starting out with the largest pool of potential buyers as possible. After those folks will have an opportunity to express interest in the practice, we'll do our initial round of vetting. And we can do so by reviewing the profiles that they've built on our platform, and through other methods, many of the folks will know, or the seller will know. And we're going to narrow down that fairly large group to a smaller group of 10 or less who are going to actually invite to bid on the practice. When they are invited to bid, they'll have access to two different areas. One is quite a number of reports that we will have collected from the seller and uploaded to the profile. And number two is to the terms of the deal that we're looking for, which we will have worked with the seller to develop. We don't ask for a specific sale price because we want to actually let people make offers. And in doing so, we collect a wider range of offers, and we can use the higher range to to negotiate with the best candidates. After the bids are received, we'll do another round of vetting and narrow that group down further to a group of usually 5 or less, and those people are going to take into the interview process. And that's really where the seller gets an opportunity to determine who the best fit is. We conduct the interview with the participation of the buyer and the seller, ask a number of questions that are very enlightening in respect to how they run their practice, their client service, and so forth. Usually when we exit that interview process, the seller has either made a decision or narrowed it down to a couple of candidates, in which case we would do further interviews or office visits and so forth to select the finalists. Once the finalist is selected, then we really help both parties complete the process by getting the bank financing lined up, getting the formal agreements completed, which we provide the attorney for, working with the broker dealer to make sure that their checklists are in place for the actual closing. And then finally, working with one of our executive coaches to plan the client communication and transition schedules. So again, our fee for this service is based on a successful sale. It comes from the sale price, and generally we're paid out of the funds the same as the seller is. So that's our Advisor Legacy platform. Hopefully you've learned today also some of the potential pitfalls in deciding how to sell, and really, what the options are, which, might be the best for your particular scenario. Just to summarize, if you can think of 2 scenarios, one more of a DIY where you say to your client, so I sold, to another advisor who I knew, or, maybe was another advisor in your office because it was the path of least resistance. Or the scenario number 2 is I hired a professional, I interviewed and vetted a number of candidates, and I picked the most qualified person to take care of my clients. I think it's pretty clear that you could see that the second scenario would certainly come across the best, and I would argue as well that the outcome of doing so is generally better than doing it alone. So that's it. I'm going to hand it back over to Tony, and hopefully we can open it up to some of your questions. Thank you.
Great, Todd. Thank you very much for that information. What I'd like to do now is open it up to some questions, and to ask a question, you can do one of 2 things, both of which you go to your GoToWebinar control panel, and you can either type in a question or you can raise your hand. If you raise your hand, I'll unmute your telephone line, and we'll be happy to answer any questions that you have. So while we're waiting for some questions, I would encourage everyone to visit our website at keymanagementgrp.com. And here you can take our free practice assessment, and it entitles you to a free 30-minute consultation. You can also reach out to us by phone. You can see our 800 number, which is 888-848-3349. Or if you want to get a hold of Todd directly, you can see his contact information in the lower right-hand corner. His email is tdoherty@keymanagementgrp.com. Well, Todd, it looks like we do not have any questions today, so I want to thank everyone for joining us on today's presentation. And Todd, thank you for your time and insights, and we look forward to hearing from you soon. Thanks.